Thank you for taking the time to join us for the Pengana WHEB Sustainable Impact Fund webinar. My name is Karen Jones and I'm responsible for Pengana Fund's distribution across Victoria and Tasmania. It's been quite a ride since we presented in spring last year. This webinar is a true global update encompassing many facets of all the changes we are all a part of worldwide. Ted Franks, partner and fund manager from WHEB, together with Seb Beloe, partner and head of research for WHEB, are both sharing the limelight this afternoon. The more formal part of the presentation will take between 40 and 45 minutes. There'll be time at the end for questions, which is always the best part of any type of presentation. So please use your chat function available on your web screen to log your questions, and we'll endeavour to get to them all at the end of the presentation. Just for your information, the webinar is being recorded and there are also CPD points available as well. On that note, it is my pleasure to hand you over to both Ted and Seb for the next 40 to 45 minutes. Thank you.
Thanks everyone for joining us this morning as it is here in the UK. Quite a lot to cover today. It's quite an eventful quarter, so I'll crack straight on. Hopefully everyone can see the screen. So, first of all, we're just going to run briefly through a very little introduction to WHEB and the strategy. Appreciate we've got quite a lot of attendees today, which is great. Some of them are newer to the strategy, but the bulk of this presentation is really about an update for the quarter. Before that though, just tell you a bit about ourselves. So we are a entirely sustainability focused boutique manager in London. We manage a single strategy, which is available to you guys in Australia as the Pengana WHEB Sustainable Impact Fund. We've been doing this inside WHEB as an organization since 2009. The strategy actually goes back to 2006. And because we're dedicated and focused on this area, we're obviously very keen and very proud that we're able to be pioneering in our approach, not just to how we invest in terms of sustainability, but also how we manage the business. And I think it's not too strong to claim that our approach to think about impact, which I'll come on to in a moment, was certainly amongst the first listed equity funds globally to think in terms of investing for impact, rather than effectively alongside sort of thematic investing. The core philosophical underpinning is this, what seems a rather straightforward idea now and somewhat proven, I would say, but at the time when we launched, we did have to convince quite a few people about it. The idea is the world is now going through a sixth industrial revolution. This is from a schematic put together by Carlota Perez, an economist, back in 2002. And this change, this sixth industrial revolution to a zero carbon and sustainable economy, is every bit as profound as the preceding 5 industrial revolutions, one of which, by the way, the tech communication revolution, is still ongoing, but we want to invest where that change is. And specifically what we saw was that the best way to do that is to invest at the point where the revenues are created for the companies that are providing solutions to make that change happen. And that's what we call impact investing. And that's quite critical, really. So over the right-hand side of this slide, which is perhaps our most important introductory slide, is a column of companies we invest in. So one of them is Aptiv, which makes components for electric vehicles, part of the EV transition. One of them is Arcadis, which is a consulting engineer. Everything they do really is about advising people on mitigating climate change and environmental change. And then TPI Composites, they make the blades for wind turbines. And what we don't invest in, obviously on the left-hand side, we consider businesses at risk, but this big central group of transitioning companies, and there are a lot of strategies out there now which bear the brand sustainable, and they're really doing that middle transitioning piece, which is picking the companies that do all the different things around the global economy and those that are transitioning, changing their businesses and their supply chains most effectively to respond to this change. And that bucket does include a lot of the really large cap names, particularly the big sort of tech names. But as far as we see it, they're not providing a solution to a sustainability challenge, so we don't invest in them. And then the last slide before I go on to the update, just helpfully to help you think about how we think about this, we've always had a thematic approach to this. Then we've seen 5 environmental themes, 4 social themes you can see around this diagram here. And this is important when it comes to explain our performance and how we think about how we've done in any period, because we think in these big thematic solutions sort of categories, and that's how we identify what we think is going on in the global economy. So hopefully that was a good, useful little starting point. And now I'll press on to talk about what happened in the first quarter, which was a really interesting quarter. I mean, they all are in the business that we're in, particularly at the moment, but this had an awful lot going on with it. And hopefully you'll see a bit more. Those that don't know us will see a bit more about the strategy coming through. So first thing, first quarter of 2021 is a big quarter for us because it's a US presidential transition quarter. Our strategy is global in nature, but is around 60% invested in the US. So any kind of US presidential administration change is big news for us. Seems a million years ago now, but the first quarter did also include the rather alarming attempted insurrection in the US Capitol building. But that didn't derail Biden's administration's inauguration on the 19th of January. And he came in with a very ambitious policy agenda, and that's really what a lot of this presentation is going to be about. And then the latter half of the quarter, we had this vaccination scheme, this idea of opening up out of lockdown. Obviously, for you guys in Australia, it's a different story, which is good for you, not so good for us. And that really created this idea that there was going to be a lot of growth coming. So it's a quarter which is characterized by expectations of growth. Those expectations were boosted straight away by the first sort of major policy achievement that Biden managed, which is the American Rescue Plan, big stimulus package, the right hand of these two pie charts that he's already passed in the first quarter. It's worth $1.9 trillion. That's an awful lot in the history of US fiscal spending. And the amazing thing really is that it comes not that long after the last large fiscal stimulus, which was Trump's Tax Cuts and Jobs Act in 2017. They're different. They're different in terms of who the beneficiaries are. They're also different because Trump's plan was a tax cuts plan, and now that goes straight to the bottom line of companies and lifted the stock market kind of directly. The rescue plan's done something similar because some of this spending is very direct as well, $1,400 stimulus checks going into Americans' pockets. But otherwise, economically, it'll go through spending channels, so it'll have a slightly different kind of impact, but still a very strong stimulus. So if you've got the expectations of growth from the vaccine and opening up from COVID, you layer on this very strong rescue stimulus package, and what you get is nothing in sort of economic theory is ever perfect, but what looks to us like a very textbook example of an early cycle move in the market. So there's a decent amount of money in global equity markets, which moves around how people think the economic cycle is. And although what I will talk to you about is longer term drivers, and that's how we invest, to explain our performance, we do look at how the cycle is moving. And what you can see here in the light blue is the sensitive sectors, which are supposed to perform well in an early cycle. And many of them did, particularly sort of things like financials and real estate, and energy now is an early cycle sector. And then the defensive sectors, which are more for contractionary periods, healthcare, utilities and staples, underperformed. These bar charts are the relative performance of those sectors in our benchmark, which is the MSCI World Global Index. So you've got strong expectations of growth, big early sector, early cycle move. We'll come on to a moment why we don't actually have an enormous amount of exposure to these early cycle sectors, particularly things like financials, and of course fossil energy is not really a sustainability solution. So we kind of know this is not a perfect time for our strategy. We'll come on to how it affects us later on, but you could see it also in specific examples of our stocks. We always do like to talk in specific stock terms. So for example, one of the beneficiaries this quarter was JB Hunt, an intermodal operator in the US, a great sustainability story. It takes cargo off the road, which is where it's generating a lot of carbon, puts it onto trains and carries it across the vast expanse of continental US. So big carbon saving. What we've seen with this strong growth expectations is a big sort of suck of imports into the US. On the left-hand side, those are the ships queuing to get into the port of Los Angeles, some kind of record being set there. That's a picture of the port itself. And this strong demand enabled JB Hunt to put some pricing power in, get some price rises and improve its margins. And it's just reported actually after the quarter end, and true enough, it's been a strong quarter for them. And another place where we've seen this very strong global growth as it pertains to our companies in particular, or these strong growth expectations, is in a shortage of semiconductors. Now, analog semiconductors in particular, so semiconductors which sense the outside world, have big sustainability applications, particularly around automotive and the so-called Internet of Things. we've got quite a lot of exposure to explicit stocks, in particular Infineon and Silicon Labs, and they're obviously again experiencing the joys of being at a sort of bottleneck, and what that does for you in terms of pricing and margins. The point about this, though, is it leads on to the second kind of big macro backdrop to this first quarter, which is, in addition to the early cycle idea, you've then got these points of tightness in the supply chain. And remember, the global economy is still quite disfigured as a result of the pandemic. So what people, of course, are worried about now is inflation. Now, 2 lines here to sort of demonstrate that. The grey bar on the right-hand side is the quarter that's just passed itself. The light blue line is one of my favorite sort of indicators. There's something the Minneapolis Fed puts together, which is a mathematically derived imputed expectations for inflation. Slightly complicated to understand, but effectively it's saying what's the probability, what probability does the market assign to there being inflation above 3% in the next 5 years? And it's the left-hand axis, so you can see that's gone up to a 30% probability. And next to it, the green line is possibly the most important economic indicator in markets, US bond yields, and they rise if expectations of inflation rise, expectations of interest rates rise, and then bonds go down. So that has been another key feature of this quarter. And that's very interesting from an investment point of view. First of all, you've got direct read across to one of our stocks that we own. In fact, the most exposed probably to sort of interest rate expectations is a French care home operator called Orpea, global operator, but based in France. And Orpea does have leverage. It also has a real estate portfolio. Strategically, they think it's important to own about half of their care homes. So that's these bar charts are the balance sheet. So the left-hand side, you can see the real estate slug, the sort of light green, and balanced by a meaningful amount of debt in the dark blue on the right-hand side. So Orpea had a tough time. Part of that is these expectations for inflation. Now, again, I promise we will get back to sustainability things in a moment, but this is very sort of macro-dominated quarter. As well as that, inflation expectations rise. That feeds into style factors around global investing, and basically implies that companies where you can make a sort of value claim that you're going to get your cash back sooner should outperform growth companies, broadly speaking. And again, nothing is perfect. So the next slide, we can see the sub-index is taken from our main index of value and growth, and you can see that clear outperformance from the value index in the quarter. And the way that we see that, because we really see everything through the lens of our companies, we have an idea internally, a relative idea within the portfolio of where we think our most and least expensive names are at the moment. Obviously, that feeds into our thinking about ownership of them. They're listed on the left-hand side here, and you can see the relative performance of them. Okay, nothing is perfect, but at least a couple, the 2 Japanese names, Kientz and Daifuku, had a tough time. Ansys is another highly valued stock that had a tough time in the quarter as well, as did Vestas. So you have this sense that, okay, there's a valuation sort of aspect rally happening here as a result of inflation. You put that all together, the early cycle, lack of exposure there, and the inflationary change, and it hasn't been a great quarter for the strategy. It underperformed across the quarter. The interesting thing for us is we have got a very good analog for what happened here, which we'll come on to in just a second. And actually, we think it's something of a testament to the changing nature of the prospects for sustainability, that in this quarter, when we had this big early cycle rally, the strategy actually held up rather relatively well. But you can see there the sort of peak drawdown from the middle of January to kind of the start of March. It was quite a marked rotation around inflation and value and early cycle expectations. That quarter that I want to talk about, this is our attribution for the first quarter, and I mentioned at the introduction that we think in terms of thematic, those 9 themes we've got. So when we attribute, we think about how the 9 themes performed. And you can see in the dotted box here a couple of kind of key standouts. The first is in this early cycle period, our health theme, which consists of healthcare companies, naturally defensive, so that's underperformed quite strongly. Resource efficiency themes also underperformed, perhaps slightly counterintuitive because that theme's actually got a lot of industrials in it. But the industrials that we invest in tend to be slightly high quality industrials, and they have more of a mid and late cycle focus. That's a slightly subtle sort of investment point there. More interesting still is that thematic selection effect, the grey bar you can see. So the thematic selection effect is the attribution to all the benchmark stocks which aren't in our universe. So in a way, it's a proxy for whether sustainability as we define it in our universe is a headwind or a tailwind for the strategy. And that number there is a pretty big headwind. It's actually the 3rd strongest headwind we've had in any quarter since we launched the strategy at WHEB. So we've got 36 quarters of data of it or some such. And what that's telling you is that the big growth in the financials and energy stocks in the first quarter made it difficult for us to perform relatively. And the point about this is, coming onto this parallel, the last time we had a big early cycle rally, which again coincided with a presidential election in the fourth quarter of 2016. And again, Trump's arrival sparked a reflation rally, this idea that inflation expectations would increase. You can see some pretty similar thematic selection effects. In fact, that in the fourth quarter of 2016 was the single largest negative thematic selection effect that we had. The important message here, of course, as you move through the cycle, our mid and late cycle exposure, which is the natural place that we find our sustainability companies reside, obviously benefits more as the economy changes shape. Now, all of that is a long explanation to help everybody understand how the strategy moves through different cycles, and I hope you find it useful. But we obviously don't invest around it. We have an average hold period that's well over 5 years. It's kind of more like 7 years, I think, at the moment. And we think in terms of sustainability drivers instead, but it's hopefully useful for you to understand the shorter term moves. More exciting, really, in this quarter is what we talked about in terms of the stimulus that the Biden administration is interested in putting in place. Now, our strategy is to invest in companies that provide solutions to sustainability challenges. And obviously, as investors, we like companies which don't rely on any kind of regulatory framework and certainly don't need fiscal spending to support them. That said, the world is very much in a fiscal spending mode at the moment. It appears that the rules of fiscal probity have been, rulebook's been ripped up and thrown out of the window. Everybody's got a license as a result of COVID to spend money. There's also a change in the political atmosphere, and people are very keen to do these populist policies. And so right now, there is a big focus on spending. So this is where we're focusing our attention as well to try and make sure the companies that we invest in are at the right side of how this new framework for solving climate change and sustainability challenges is going to work out. And of course, the regulatory side is part of that, but that'll come further down the future as the spending phase passes through. So this bar chart is the next phase of the proposed stimulus from the Biden administration. It's got its rescue plan away, that's 1.9 trillion, as we said earlier on. It's got this American jobs plan, which is 2.3 trillion, amazing. And it's actually got a third tranche coming down the track in due course as well, which is the American Families Plan. And the American Families Plan is likely to feed across into a lot of our social themes. The Americans' jobs plan's got a big infrastructure element to it. And moreover, as this kind of bar chart hopefully shows you, it's got a big green infrastructure element to it. So the left-hand side is kind of the generic description of how the proposed, this isn't passed into law yet, but how this plan is proposed to be spent on sort of generic titles of spending buckets. The right-hand side is this analysis from the Center for Strategic and International Studies, a US think tank. And they're basically saying that those blue bars at the top, you could say that 56% of this proposal is related to climate goals. And that certainly matches the rhetoric and the ambition of the Biden administration. So it's a big deal in our sector to see this much money being put where people's mouths are about making a change to climate. And thankfully, I'm now going to have a chance to just skip away from the US just briefly to say that there's another big stimulus, not as big as the US, but still in European terms, very, very large, 1.8 trillion euros available for a similar kind of COVID relief and green transition in the EU. It's got two vehicles that do it, the Next Generation Fund and the Multi-Annual Financial Framework. In sort of true European style, the generic buckets here have got wonderful names. So 60% is going to be spent on cohesion, resilience, and values, which is good. I'm sure we understand exactly what that is. But about 30% of the total, if you look through that, looks like it's climate related. So again, we've got these big government intentions to try and support the transition, which is fantastic. You know, will it be in time? Who knows? But certainly in our long experience of investing, this is unprecedented. And so the question for us is just making sure that our environmental themes are matching where this money is going to be spent. It's a big challenge, spending wisely. And for us as investors, the key, this rather nice image which I've taken from the Energy Transitions Commission, if you look at the three columns, the top of it, so emergence, diffusion, and the new normal, the way this strategy invests is really in the diffusion column. So we try not to take too much technology risk down the bottom end of the curve, although obviously we will reach in where we can see, we have strong conviction on the case. But much more it's about trying to find companies who've got a proven position and a proven technology and watching that expand through to provide part of the solution. And it's really about matching where the focus seems to be with the companies that are best placed to benefit. And so being specific about that, we put this sort of box chart together from another, so many, never a shortage of think tanks, another think tank, the World Resources Institute, split that sort of proposed 2.3 trillion from the American jobs plan into different buckets. And we've put our logos of some of our companies, not all of them, they didn't all fit on, and these are the ones which we think are most securely positioned to benefit. Into the different categories, you can see we've got good exposure all across these areas. And our work now is really to make sure that we understand, if there are going to be strongly supported sectors with a real chance of change, that we've got the right companies to benefit from those. So that's the big, interesting long-term implications of the first quarter of 2021. It follows 2020 when all the big commitments were made, the net zero carbon commitments, and now it's about real action, in this case, spending actions. I'm just going to leave you with a couple more thoughts before I hand over to my colleague Seb to talk you through some other aspects of the quarter. So the first one is that, very similarly to the last time we had this start of a cycle, expectations for growth and inflation, which was 2016, that did result in a nice period of growth through 2017 and 18, and then it became unstuck through the middle of 2018 with the emergence of the global trade tensions, particularly between China and the US. And the Biden administration has absolutely picked up on the same themes, and quite rightly so. And there are things to really think about in terms of China's values, and do they share the values of the Western world? And so we do have these ongoing trade tensions. The picture on the left is this Alaskan summit that's already happened between China and the US, and one of the most remarkable carpets, I would say, in global politics. I'm sure it seems amazing there wasn't a nicer carpet in Alaska, but that's the one they chose. And the rhetoric there was pretty harsh, strikingly so, really. The interesting thing on the right-hand side is that, I guess now a week and a half ago, John Kerry, the US climate envoy, was in Shanghai, and the noises coming out of that meeting were much more positive, suggesting that they would the two superpowers would try and find a détente to work together on climate goals, even if the underlying tensions were unresolvable. Although, of course, even since then, Xi Jinping has given a speech which was, again, very sort of aggressive. So we watch this very carefully. For our strategy, which is full of global companies who want to export globally, they've got technology which provides a solution anywhere around the world, then deglobalization is a real challenge. And more generally, deglobalization is a challenge to solving sustainability issues, as you might imagine. So we're hoping that there'll be a way to work through this. And then my very last slide is just returning to a little bit of that attribution, how we think about our performance. And this is to observe that over the last 12 months, something quite remarkable has happened. Again, we've got 36 periods of 12 months rolling attribution since the strategy came to WHEB. Unfortunately, we couldn't have the data for the period where it was run before we were at WHEB. But in all that time, we've never had 12 months where the thematic selection effect has been as negative as it's been over the last 12 months, which is remarkable because actually the broader policy picture around sustainability has never been brighter. But what this tells us is that this recent growth cycle has been very, very strong, stronger than the end of the previous cycle, which we sort of saw in 2020. And more than that, there is this big other growth area in global equities, which is technology, consumer technology, which we don't invest in. And I guess our message here is, notwithstanding that big headwind, the fund has performed quite well, really. And what it shows you is the right companies exposed to sustainability perform very well relatively in any context. And on top of that, we think that the opportunity is really ahead of us in terms of sustainability coming to the fore in global markets. Feels like I've been talking for ages. So what I'll do now is I'll hand over to Seb, whose head I can see, and let him talk you through the rest. And very happy for questions.
So I'm going to pick up from Ted and just take you through some of the portfolio activity this quarter, in particular talking about a company called Kingspan, which we've sold, and then I'll spend a little bit of time at the end on some of the challenges around greenwashing and the new regulations that we're seeing come in to deal with that. So, sorry, wrong way. So just firstly, in terms of the company that we purchased one new company in the quarter. That's a company called HelloFresh. It may be familiar to some of you. They're the largest meal kit delivery company in the world. They're headquartered in Germany. And they provide menus of different recipes on their website. And as a customer, you can select the recipes that you like, and they will deliver those, or they'll deliver the ingredients to your house, and you can prepare the recipes yourself. It's all based on fresh vegetables, and it makes cooking fresh food very accessible to people who would otherwise struggle perhaps to prepare fresh meals. So it sits in our well-being theme. Their product is fundamentally about enabling access to fresh food for people, and they're very carefully calorie controlled as well, and that's part of their proposition. The business model, though, is also quite interesting in that it also delivers significant reductions in food waste by up to 2/3, actually. And as many people I'm sure will know, food waste is a major problem in the food and agriculture system that we have. So cutting it by 2/3 is very significant. They do that by sourcing directly from farmers, that little model on the right-hand side on the slide. And also because they're providing you with the exact quantities that you need in your recipes, it reduces food wastage at the household level as well. So we're excited by the prospects for this company. We bought it in February and hope to hold it for many years. So that's the purchase that we made. And then we sold 2 companies in the quarter. The first was a company called Renishaw, which we first bought in April 2016. It's one of the UK's few remaining manufacturing leaders, and basically they make industrial metrology equipment, which is basically a series of probes, and you can see a picture in the slide here, that are used to measure things very precisely, and they're used in manufacturing lines to make sure for quality control and for making sure that products that need very low tolerances for errors are manufactured very precisely. So it helps to reduce wastage and improve efficiency as well. They also make 3D printing machines. It's a very popular stock here in the UK, and you can see the valuation has significantly increased over the period that we've held it, going from, in green, the next 12 months PE against the FTSE, the local market, gone from about 1.5 times when we purchased it back in 2016, and it's about 3 times now. And then you can see the next 12 months PE in blue on the right-hand axis as well, gone from 20 odd times to nearly 50 times. So valuation has been a concern for us, but actually the decision to sell was prompted by the 2 founders, Sir David McMurtry and John Deere, you can see in the picture, both getting on a bit. They're in their 80s, they own 52% of the business, and they have decided to sell the company. And it's what we call a culture company. It's a very got a very strong culture, and their decision when they announced it was that they wanted to preserve the unique heritage and culture of the business, which we applaud. But it suggests they're not going to be maximizing value in the sales process. So we've exited that position after 5 years of holding it. And then the other one is Kingspan, which some of you, I'm sure, are familiar with the company. They make insulation materials for buildings. It's been a very popular stock for most of its history. It's an Irish headquartered business, and very popular for good reason. Obviously, building insulation is a very effective way of improving efficiencies in buildings and reducing greenhouse gas emissions from buildings. You can see the CO2 savings that they believe they are responsible for with their product on the slide. They also use a lot of recycled bottles in their manufacturing, so they reduce plastic waste. And as a business themselves, they're committed to becoming zero carbon. In fact, 100% of their energy is sourced from renewable energy already. So it's a very likable stock for many reasons, and we were very happy owners for many years. But in June 2017, there's a tower in West London called the Grenfell Tower, and this caught fire on the 14th of June. And for those of you not familiar with it, it was a catastrophe. 72 people lost their lives. It was the deadliest residential fire in the UK since the Second World War. And since then, a variety of events have revealed a lot about Kingspan's internal workings that were previously very much hidden from public. So on the 21st of May, the Grenfell Tower fire inquiry, an official public inquiry, was launched. And then at the end of last year, on the 5th of November, the company issued a detailed opening statement in which they admitted to some significant shortcomings around product safety testing and also marketing information that they'd found at the business. And then through November, December last year, we heard from a variety of Kingspan employees and ex-employees. And this was reported extensively in the media, so I won't repeat it all here, but it was deeply shocking to understand what was going on in parts of the company. And it certainly indicated that within the UK business, they had a very aggressive approach to product safety regulation. And they were quite willing to bully and intimidate internal whistleblowers, as well as third-party testing bodies and even clients. And then on the 19th of February, the company issued a further detailed statement with their annual results, setting out further actions that they wanted to take. We decided to sell our position at the end of February, and then we reviewed the process that underpinned this decision with our advisory committee in March, and we published the summary minutes of that meeting at the end of March. So in terms of the actual decision-making, I won't go through all the detail because I don't have time here, but we looked at the involved literature reviews, we followed the inquiry testimony, we interacted with the company on many occasions. And in summary, what we tried to do was assess Kingspan's historic approach that was revealed through the inquiry to product safety, and compared this and their proposed remedies against the best practice framework, which we'd sourced from academic literature. And we reached our conclusions and then walked through the process with our advisory committee. And it was clear, really, to us at least, that Kingspan products, we don't believe were responsible for the fire. The inquiry heard that the cladding as a whole, the cladding system as a whole, was flawed. But clearly, and by the company's own admission, they had a pretty lax approach both to product safety and the use of safety information in their marketing. And in our view, they have a culture that prioritized commercial advantage over product safety. And there were several examples that were given during the inquiry where the company sought to stifle or undermine criticism of the product used at Grenfell, and where they'd look to exploit loopholes in product safety tests. So for us, at least, it's difficult to believe that the group management of the whole business wasn't regularly involved in this UK business. The insulation boards is the most profitable part of Kingspan, and the UK is still a sizable portion of group revenues. So although there are lots of positive changes that are now being made at the company in terms of how they handle product safety information and the governance and scrutiny of that, overall, we still think that the cultural issues remain deep-rooted and somewhat unaddressed by the changes that are being made. And so we sold our position at the end of February. There's more detail in the quarterly report and also in the advisory committee minutes, which are on our website. So just as a final topic before we turn over to questions, I wanted to talk a bit about greenwashing and some new regulations that are emerging in Europe that we're having to deal with, and may well, although they're just for European funds, they have, I think, a bearing globally as well, as the first efforts by regulators to try and address greenwashing in marketing. So as context, I'm sure you're all very familiar with charts like this that have shown just how quickly and how popular investing in ESG type products has become. You can see on the left-hand side just the extraordinary increase in the volume of money going into a variety of different types of ESG or green products, and the volume of money that's going into passive ESG products and sovereign green bonds in 2021 already exceeds the whole of 2020. So this very rapid growth is continuing. This is from Morgan Stanley data. And then also in terms of the number of funds, you can see in the chart on the right-hand side, both the growth in the number of newly launched ESG badged products in blue, and also the growth in the number of funds that have been repurposed to ESG from something else in green. And I imagine I'm talking to an audience who are very familiar with this story, remarkable as it is, but concerned that at least some of these products may not be as green as they claim, indulging in so-called greenwashing, really hit the headlines in a big way at the end of March, when this fine gentleman, Tariq Fancy, who's a former chief investment officer of sustainable investing at BlackRock, made some very well publicized comments in the opinion pages of USA Today. And you can read the quote that he made in that article. But he went on to say that sustainable investing was essentially the medicinal equivalent of giving wheatgrass to a cancer patient, a waste of time. In fact, worse than a waste of time, because it distracts us from taking real action, in his view. I imagine that many of you are sympathetic to Fancy's position on this issue of greenwashing. And while I clearly don't believe that all sustainable investing is like wheatgrass, I'm also skeptical about some of these claims. This is a tweet that I think probably reflects a fairly common reaction to some of the ESG fund launches that we've seen. It's about a fund called the Carbon Transition Readiness Fund, and focuses, and I quote, on investments in shares of Russell 1000 companies that are deemed to be best positioned for the energy transition, taking into account issues such as clean technology and water and waste management. And then when you look at it, actually it's just a load of tech and banking stocks, although it does also include Tesla. And obviously for Chris Sacca, who's a US venture capitalist, it's not clear why these stocks belong in a carbon transition fund. And frankly, it's not clear to me either. And it's not actually, wasn't clear to Bloomberg either, who published this headline 5 days after the launch of the fund a couple of weeks ago. So regulators are beginning to wake up to these issues, and the Europeans, I think, have been first to launch a couple of new regulations that are intended to better control how fund managers promote their products from an ESG point of view. And in March, the first of these, the Sustainable Finance Disclosure Regulations, came into effect for all funds that are marketed into the EU. And essentially, they require fund managers to self-certify how central sustainability is to their investment process. So-called Article 6 funds are funds where there isn't any integration really. Article 8 funds have some element of integration, and then Article 9 funds are where sustainability is core to the investment process. And we all had to do this and make an announcement at the beginning of March. By the end of March, Morningstar did some research, and they found that 78% of funds had been classified as Article 6, 18% as Article 8, and only 4% as Article 9. So that regulation has forced some differentiation in the market. You'll be pleased, but I hope not surprised, that the WHEB fund is considered to be an Article 9 fund, so putting sustainability at the core of your investment process. And there are reporting regulations that will go with that in due course. So that's the first thing. And then the other one is another regulation linked called the EU Climate Change Taxonomy, which I'm sure many of you are familiar with. It's essentially a list of projects and technologies that the EU consider to be making a contribution to either reducing greenhouse gas emissions or helping the economy adapt to climate change. And managers need to assess what proportion of revenues are coming from these kinds of activities. The taxonomy itself hasn't yet been finalized, and companies aren't yet reporting this data. So at the moment, people are providing guesstimates of what they think their exposure is, and we've done an exercise at WHEB. Bloomberg have a tool which tell us that it's 64% exposed to the taxonomy, but actually we only have 60% invested in environmental themes. So we know that is an overestimate. Our own more conservative estimate, we reckon we get somewhere between 12 and 36% of revenues from taxonomy eligible activities. But in practice, of course, this is only affecting our environmental themes, and it's probably 20 to 60% of our environmental themes. And this is only about climate change. The EU is proposing to come forward with new taxonomies on other environmental issues like the circular economy, and also potentially a social taxonomy too. Once those have been developed, we think that the vast majority of our strategy will qualify for those taxonomies. And then finally, like a lot of regulation, they can, and certainly in these cases, we think are quite a blunt instrument for encouraging asset managers, in this case, to address sustainability. And there are several more market-led initiatives which we think are quite interesting, still in their early stages, but worth keeping an eye on. The first is the work of the British Standards Institute, who are developing a series of specifications on sustainable finance. We've been part of the technical committees working on those specifications, and that's, we think, pretty exciting work and worth keeping an eye on as those come out. And then secondly, a couple of initiatives very much focused on greenhouse gas emissions reductions, the Net Zero Asset Managers Initiative and the Net Zero Investment Framework. We are committed to both of these, and you can see our commitments on the slide that focus on both getting the companies that we invest in to commit to going net zero carbon. And you can see that we've got various targets there. We think about 20% of the portfolio is already committed to net zero carbon. By 2025, we want to have at least half of the portfolio committed to going net zero carbon, and then the whole lot by 2030. And then, of course, what really matters is the absolute greenhouse gas reductions. And there too, we've set targets. We want to see a 50% drop in portfolio emissions by 2030. And then, of course, 100% drop on 2019 levels by 2050. So we think those are quite useful initiatives that are really holding asset managers to account in terms of delivering positive impact and reducing carbon emissions. So I hope that's been a helpful tour of the last quarter and some of the initiatives that we're working on. I think we've still got a bit of time for questions. So thank you very much.
Thank you, Seb and Ted. We do have some questions coming through. The first one's a bit of a tough one. Are you ready? The first one comes in from one of our New South Wales advisors. Do you think China will be able to separate climate change goals from ongoing diplomatic tensions, particularly with the US and India?
Well, that's a big question, isn't it?
Yeah.
I mean,
in the interest
I think
of time.
yeah, no. I mean, broadly, actually, I think they'll struggle. I think they will. It is quite a thing for them to have put themselves in a position where the rapprochement they put into place with the West over 2 decades, for that to sort of be uncovered and replaced by this much more aggressive approach now, and then expect it to be easy to find topics not where there won't be a difficulty. And the other side of this is that the West is absolutely champing at the bit to give jobs to its people who have suffered from obviously a lot of offshoring to China over those 2 decades as well. And they're pushing at an open door if they want to get the Americans to start building stuff onshore again. I think they'll really struggle, but it's important for all of us, right? So we wait and see. Yeah.
I guess another fairly kind of large question has come through based on inflation as well, and you did touch on that in the presentation and covered it off mathematically. And I'm very, very aware that a lot of our fund managers are conscious of inflation and where it's heading, but it seems like global regulators and central banks are presently ignoring that space. What are your thoughts about inflation off the record, and how would you position the portfolio going forward? No one's listening, it's just you and me.
Yeah, inflation. Well, I can imagine obviously it's a lot of focus in Australia with the big sort of commodity price spike that we've seen and other things that are going on in the economy there. And it's a big focus across the world. I guess the key for me for inflation is expectations. And they have become so muted for so long that you could potentially describe them as complacent. And then you get this risk that then the second derivative of change becomes very powerful because you swing through the bottom of the pendulum. Suddenly you get these big spikes and changes in sentiment. So trying to put that into sort of plainer English, I think since 2016, we tried to be more careful about valuation in the strategy. We've always been a kind of growth at a reasonable price strategy. Turned out to be the wrong thing to do in the last 4 years because actually people cared less and less about valuation. I think we now are continuing to feel very careful about not overpaying for stocks because we expect there to be some uptick in that great inflation expectation kind of sense around the market. And you can point obviously to tensions with China is a big source of reducing the ability of companies to reduce costs, and against which, of course, technology will remain a very deflationary force, as will aging populations. So our sense is, yes, there'll be a little bit more inflation expectations. There'll be a little bit more inflation, and we're going to try and position appropriately. But I mean, it's a big question, and it's really, remember, our strategy is much more about finding companies which are solving sustainability challenges, which have lovely secular long-term growth opportunities, and trying not to be too caught up with either cycle or style so much, and rely more on a sort of bottom-up approach. So hopefully it'll just be kind of an overlay rather than a core to how we invest.
Okay. I think the tail end of your answer to that question sort of leads into the next one as well, but I think it's quite a good question. What is your process for monitoring impact sustainability sentiment across your portfolio and evaluating how this may impact the value of the portfolio? And the second part of the question is, how do you establish trust in the data you use to evaluate these sentiments?
Good, great questions. Yeah. I'll try and play Seb in here a little bit. I mean, I think the answer to how we evaluate, so if you think about how we evaluate impact, we have various methods to do that. And the most sort of critical one that we developed over the last number of years is our impact engine, which allows us to effectively score whether we think a stock is more or less impactful. And without this being particularly scientific, and in a moment, maybe Seb will explain how the impact engine works, but without being too scientific, how it feeds into the process and thinking about valuation is obviously we can then sort of score how we're seeing the multiples move, the valuations move for the names which we think are more impactful, and where we think there's a particularly strong impact narrative. And what we try and do is blend through the maximum impact we can effectively for the value opportunity that we think matches it. So if you go all in, pure impact, those stocks can be very expensive at the moment. And as per my previous question, we're trying to keep some value discipline as well. But Seb, I mean, do you want to just quickly explain the impact engine a little bit, just the basics of it, maybe?
Yeah, I mean, so the methodology, for if you're really interested, you can download the methodology from our website. But the impact engine is designed to try and capture all the different dimensions of impact that can be associated with a given product and service. So it looks at who is the beneficiary of the impact, how critical is that impact to them, how central is the company in terms of delivering the impact? Is it manufacturing the critical technology, or is it just a sort of distributor of the product? How much, in terms of the impact, how much of an improvement do you see, and how unique is the company's contribution as well? Is it the only company that can do this, or are there others? So it tries to capture all those different dimensions of impact into a rating that we have, an impact intensity rating, we call it. And as Ted's described, that then sits at the heart of our investment process. So it really makes sure that we're understanding the different dimensions of impact and making that a meaningful part of how we invest.
Okay. And then I guess the second part of that question, of course, is how do you establish trust in the data that drives behind it? Now that is a question again back over to Seb. What do we think about the data that we have in our, that we're making, reporting on our impact from?
Yeah, I mean, I guess you could make that question about any kind of data that we use. I mean, the data that we get on sustainability and ESG, we collect that data ourselves, so we don't rely on a third party kind of rating agency or anything. We are interested in understanding the data ourselves. Typically, it's reported by companies, not always audited. So yes, quite right to have a question about the integrity of it. But we do get data from third parties through NGOs, for example, through regulators as well. So we can kind of triangulate around the data that we get from companies, and we don't rely on any sort of single data point. What we're trying to do is build up a picture, a kind of composite picture of a company in terms of its sustainability, coming from multiple different sources. So we think there is some degree of verification by using a range of sources that allows you to, you're not just relying on the company reporting data themselves.
Okay, thanks, Seb. On the question of data, there's another question that's come through. I have an advisor here who uses the impact calculator for their client reviews and loves it, but does have a question around when the data will be updated, because obviously currently it's still to the end of December 2019.
Yeah, so we are in the thick of collecting that data at the moment. The impact report and the new data for the calculator will be available by sort of mid-June. I realise that sounds late, and Ted has already had a go at me for being ridiculously late. I mean, partly it's because we do rely on companies reporting the data, and it takes them a while to do that. So we're driven by the timetables that the companies have for their own reporting.
Okay, excellent. Because I know there's a lot of advisors out there who do use the calculator, and their clients really enjoy referring back to it. And just on that note as well, for anybody who is on the webinar today, just contact your local regional distribution manager. We'd love to take you through the calculator and the other resources that are on our website as well. Clearly, the Kingspan experience was a pretty difficult one for you to go through. You touched on, I guess, a few of the things that you learned from that. Are there any other companies that you're interested in looking at? Obviously, that installation space is really important. Anything else there in the pipeline?
I mean, well, so yeah, insulation and buildings in general, very important. If you think about it, it's kind of the third or fourth largest source of CO2 emissions. It's very nubbly, because actually what you need to do is you need to retrofit a lot of these buildings, and then that's tied into the value of the buildings, and that's tied into interest rates. And so getting the world, if you think about the really difficult bits of carbon to get out of the value chain, buildings, food, aviation, these are the really challenging ones. Yep, there are several other companies. I mean, Kingspan, we did think, that extruded plastic insulation is light, it's easy to move around, it's got a lot of technological advantages, so it is in a very good place. The names on the insulation side, Rockwool, Owens Corning to a certain extent in the US, the manufacturers, we sort of look at those. None of those have passed the bar for investment at the moment, but we sort of are aware of them. And then there are sort of, Saint-Gobain's got other bits in its business. There's a UK company, distributor called Sheffield Installations. There's a US thing called Building Product Solutions. So there's a few names around it, and more broadly around buildings in general. You've got the other bits of it, heating and cooling, building control, those sorts of things, and design as well, design into buildings. But I think it's fair to say we haven't been able to like for like find something to raise Kingspan. So I guess that just emphasizes just how significant we thought their failings were that we did exit.
Okay. I have an advisor who's just sent a question through, who is doing due diligence in this space for the first time. And they're finding it quite complicated. And I think your slides on greenwashing probably underlined why it is so complicated. The advisors actually asked for just 2 or 3 bullet points that sets you apart.
Sets us apart?
From competitors in this space or your peers in this space.
Gosh, only 2 or 3, crikey.
Yeah, I know.
Well, shall I have a stab at a couple, and then
yeah, go.
2 or 3 as well. So I think one of the important differentiators is this is all we do. We're a boutique that's wholly, one of the reason I would say that Ted, George, and myself, the partners at WHEB, came to WHEB was because we wanted to dedicate our careers to sustainable investing. We're not interested in investing in other ways. This is what we want to do, and we have a business that has a mission that's focused around sustainable and positive impact investing. So there aren't that many other boutique businesses that just have that. You can trust us because this is all we do, and this is what we're passionate about. So that's one thing. I think the depth that we go to in understanding impact is still pretty unparalleled, at least in listed equities. The impact engine that we've described, the amount of reporting that we do around the impact, the transparency that we have around the product, I think really, I hope, underlines just how core it is to what we do and how we think about the market. So those would be two.
Yeah, I mean, what to add? I mean, absolutely, sort of the authenticity of it, as Seb says, the idea that, you know, we have these twin goals, outperforming and also delivering maximizing impact. We're trying to combine the two of those, and we're not going to cut the corners and try and greenwash certain names in just to try and get the performance. We're also long-term, which is important. We think it's very important to be long-term supportive shareholders, so you can really feel that your money's having that impact. And the other thing is, you know, you've got to look in detail at what the strategy ends up sort of looking like. We find, for various reasons, we can go into, very happy to speak to anyone and talk through the strategy in more detail, but we're in these focused sort of mid-cap names which really provide a solution. We've got the blend of the social and the environmental themes. We're not taking particularly strong valuation or technology risk, and we've got this long track record which shows very clearly how the strategy performs. And so we're very careful and dedicated to that process, so you can really see what we're going to do. It's very transparent. So there's lots of reasons that people like us, and we've, you know, been around for a long time and now having success. So hopefully there must be something that works for a lot of people.
Absolutely,
Yeah.
Yes, and I would support that. I guess I describe the strategy as not being a box ticker. You actually do tick all the boxes. So you are. All right, now we've got about 3 minutes to go, and I'm afraid I've got one of those sort of bigger than ever questions.
Oh, good.
So you ready for this? You might need a bit more coffee. Are you anticipating any market corrections in the short to near term? Why yes or why no? If yes, what are your thoughts on the nature of subsequent recovery? Will it be like 2020 or look a bit drawn out over the years? So
okay, so big
question.
Big question. Of course, we try not to, you know, we do our process. You find the impactful company, you get on board that you like the company, and then you try and look and see how the next sort of 5 years is going to work. So thinking in the sort of short and medium term, not typically what we do, but I will say that I think this process of people recalibrating their inflation expectations is going to make for natural volatility, and I think that obviously could be downwards. I think that it's likely to be a bumpy year, 2021, overall in terms of markets. And you've got a couple of things going on. You've got what will the actual growth, GDP growth look like? You know, will that disappoint? And then you've got the overlay of that. Where is inflation going to go, and where are the valuations going to be? So I guess I would say I think it's certainly possible that we will see further sort of market downward moves through 2021, and then, you know, sort of recovery. We've become so used, the equity markets have been so strong, people just think that they sort of rise forever. Like it is interesting to see what happens further forward. We're obviously putting our store in the fact, our faith in the fact that there is this enormous need for this sustainability transition, and for our companies themselves, the fundamental economic value will continue to be delivered. So over the next few years, we see that as effectively positive. So we are quite confident that it'll be a good place to invest, you know, as far as the eye can see, really. But yeah, I guess I'm not expecting 2021 to be smooth sailing by any means. I don't know if that's a helpful answer. There's definitely people who think more in these terms than we do.
It's always a difficult question, and we quite often never know where a correction's coming from. So I think, as you say, if you're investing in strong companies with good revenue in any market cycle, and particularly growth companies, hopefully you can't go wrong.
Well, that's the hope.
We actually come right to the end of the time. So well done. Thank you so much, Seb. Thank you so much, Ted. Please keep up the good work. For everyone who has attended today, thank you for putting the time aside as well. We will be following up with CPD points for you, but please feel free to contact any of the regional distribution managers in your area if you've got further questions, or would, you know, like to catch up with us at some point in time as well. Have a great evening in Australia and a great day in the UK. Thank you.
Great. Thanks, Karen. Thanks, everybody.